Well, look, I mean, obviously there's always stocks to buy and there's always stocks that are vulnerable. But at the index level, that's right. Our call has been that we're pretty full because our view was that rates were going to go up. And to be honest with you, Sarah, I'm surprised it took this long. Of course, when we have all this sort of pent up movement, when the dam breaks, you get these big moves like this week in rates. And so, look, we're adjusting. And I think this is good. This is what we've been waiting for. We want rates to adjust to where they should be based on the economic outlook, which is robust. And once that happens, then we can move forward. But I don't think the rate adjustment's done, number one. And I also don't think that some of the other concerns that we've had about the market are completed. For example, there's still a lot of leverage in the system, meaning all of the major market participants, whether we're talking about institutions or retail participants, are very levered right now, right? It's been a one-way market, not a lot of two-way risk. But we actually saw a lot of shorts get taken off at the end of January due to some of those short squeezes. And so I'd like to see that leverage come down as well as rates, kind of stabilize in here, and then that will give me a signal that it's probably time to get more aggressive at the index level. In the meantime, we still like a lot of stocks out there that are levered to the recovery.
Well, that's what I wanted to ask. Go beneath the top line. What sort of sectors do you want to be in as we go through this adjustment process on rates, as you call it?
Yeah, I mean, clearly, as you go through an adjustment process like this, everything's going to get hit across the board. So the things that are going to do the best in the very near term are going to be your defensive sectors like we saw today. However, we're not that excited about that area. We continue to be favoring areas that are levered to economic growth and rates going up. So banks, materials, some of the industrial parts of the economy, even some of the cyclical parts of technology. We've been overweight, semiconductors and hardware, and underweight the software internet space because that's the area that's most vulnerable to this rate rise. So those are some ideas.
Do you think that the pullback today was related to GameStop in any way, and does that make it potentially more temporary?
Well, first of all pullbacks in the bull market are temporary, Wilf. I mean, it will ultimately be a buying opportunity. The trick is figuring out how deep the pullback will be. I don't think this particular one is over. I think the situation in January, I think that was a one-off. I don't think that's what's weighing on the market right now. I think we've moved past that. I think what we're dealing with now is an interest rate environment that's mispriced, that needs to adjust, and this excess leverage that has gotten into the marketplace because it's just been such a great, initial start to the year.
Shepard Smith here. Thanks for watching CNBC on YouTube.